What is up? Welcome to the September 2023 market update. And this month, I wanted to talk about a few things that keep showing up right now. Just finished up a conference and there was a lot of conversations around the market and our predictions and what's going to happen and why it's going to happen. And it was really interesting to get multiple perspectives over multiple days. But there was a couple of common themes, and I thought it might be helpful for you guys to hear about this and kind of understand it. I know we've talked a ton the last several months about supply and demand and interest rates and all of these things, but I wanted to put a little context around it after having kind of sat through a few days of this. So the first thing I want to cover right now is supply and demand as it relates to how many transactions are happening here and across the United States this year versus last year versus 2 years ago. A couple of years ago, we were north of 6 million sales in the United States. Last year, we were just north of 5 million, and this year, we're gonna probably end up just north of 4 million home sales. What's interesting is that actually right now this year, we're on track to sell about the same amount of houses in the United States as we did in like 2008 and 2009, which is insane because we all remember how terrible that was, right? If we're only selling 4 million houses now and we sold 4 million houses back then is now just like then. And of course we can't predict the future, but there is one thing to look at that's a major difference. At least here in Maricopa County, during that time in 2008 and 2009 versus today, there's actually about 5 times less inventory than there was back then at that same time, which is why prices are hanging high. Even though we're down 2 million sales in the United States, there's way less inventory than there was back then. And so supply and demand have balanced out. The other thing that came up a bunch over the last few days was interest rates and trying to understand why interest rates have stayed so stickily high. I don't think stickily is a word, but anyway, we're gonna stick with it. First of all, the Fed was a very big buyer of mortgages during the last few years, and they were one of the biggest buyers of mortgage-backed securities. And so no matter what mortgages were produced, there was a buyer because the Fed just bought them. But the Fed has stated now they're not only not gonna buy any more mortgages, the Fed's actually letting those mortgages roll off the books. So that only leaves what we would call the secondary market. So that means someone has to buy the mortgages, because sometimes that's the bank that lent you the money, sometimes it's a servicing company, but the mortgages get sold and passed around. What's happening right now is because rates are high and everybody feels like rates are gonna come lower, if you get a loan today at 7.5%, and then rates go to 5% next year or 5.5% next year, you're not gonna keep that 7.5% mortgage, you're gonna refinance it. And so since they know they're only gonna have that 7.5% payment for maybe a year, maybe 2 years if they're lucky, they're not willing to pay anywhere near as much for it as they used to be. That's created this spread that's bigger than normal in the rates because that's the only way that there's an investor for it on the back end willing to buy it since they know they're not gonna get it for very long. So I know that's kind of complicated, but what that means to you as a consumer is unless that back end mechanism kind of changes up a little bit, we're really unlikely to see rates drop anytime soon. Which brings us back to our friends, the Fed. And we've got some new economic data that's happened over the last week or so where consumer price index, which is like how they gauge the inflation, that's in fact rose up a little bit, which was not the right direction, again, from the Fed's perspective. The consumer's still looking strong. Retail indications are still strong. Employment is still strong, and there's still wage growth. And so as long as those things are happening, I don't see a world where the Fed is gonna lower interest rates. At best case scenario, based on the data as we're getting right now, I would say hopefully the Fed just holds steady with the rates that they currently have. But a lot of people think there might be one more price increase coming in November. When the Fed's looking at all these things and their mandate is to get inflation down, they're likely to hold this up there. So if you're thinking that you're gonna see a change anytime soon, it's highly unlikely. Here locally in Maricopa County, we are starting to see things just slow down a little bit. Our inventory's up just a touch. Our average sales per month is down just a touch. Again, it's not enough right now to call it a trend, especially because we've kind of had this extended heat where it's been like 100 million degrees. Historically here, as temperatures start to break now, between now and Christmas, we start to see activity ramp up with buyers, open houses get busier, things start happening. So It's something we want to watch, and next month we'll talk about it again in our update to see where we're exactly at with this. But right now we are just starting to see just a little bit touch signs of slowing. So we definitely want to check on that and see if that starts to impact prices. Like I said, right now it's kind of more like a rounding error and not enough to call it a trend, and definitely not enough to drop any prices. So that's what's going on here. If you have any questions at all, please feel free to reach out. We'd love to talk to you about your specific situation and see if there's anything we can do to help. We look forward to seeing you guys next month, and have a great day.